Welcome to Rhett and Ross Trading Journey. This is going to be an introduction to basic technical analysis. I'm mainly going to focus on candlesticks, patterns, and trends for the basic beginner. This is going to help whether you are in Forex, crypto, the stock market. Every market is going to use these candlesticks and most of the patterns and trends that I'm about to go over. So let's go ahead and dive in. Here we have the basic bullish and bearish candle. Now these are the Japanese candlesticks, and what they do is they are chart units that display price action. Each candlestick is going to represent a specific time frame, and it gives data on the price open, the high of the price, the low, and the close during that candlestick period. Now, standard candlesticks are going to consist of three things: the candle body. That's the main part of the body that you see. Then you have the upper, where it's high and close. That's the upper candle wick. Then you have the lower candle wick. That's where the open and low is. Now, the candle body, what this does is it's going to show you the open and the closing price of that candle period. The tip is going to show you the highest price that candle went to, and the lower candle wick is going to show you the lowest price that candle went to. Now, obviously, there are the two types. You have the bullish candle. This is going to represent a increase in buying power. The buyers are in control. This forms when the price opens at a certain price, say $20, and then closes at a higher price, we'll say $20.50. Obviously, that is exaggerated, and just as an example, this candle, being that it went from $20 to $20.50, represents a price increase. The default color is going to be green for bullish. A bearish candlestick is going to form when the price opens at a certain level, we'll say $20, and closes at a lower price. For this one, we're going to say $19.50. This candlestick is showing a price drop. Obviously, it went from $20 to $19.50. The default color on the bearish candles are going to be red. Now, on TradingView, you can actually change your candle colors. I personally have mine as red and green just because it's easier to see, easier to understand, and overall just easier to deal with. Many people don't like the color red and green, so some people have theirs as purple and pink or some other color that they prefer. Now, each candlestick is going to mean different things when it's sitting next to another candle or as part of an overall trend. With this, it gets easier as you learn and constantly study. I personally, this was one of the first things that I learned. One of the members in the Vision Algo Discord, Billy Hess, he's actually the one that taught me how to read candlesticks. So I definitely want to give a shout out to him. And I appreciate all of the work that he put into helping me learn. It was a long process. All right, so here we have a few different single, double, and triple candle patterns. With this, each one is going to tell you something different. So, for example, we have the first one in the top left corner. That is a bearish engulfing. Now, this one is going to show up during a bullish trend. So if the stock or the Forex pair that you're looking at or the crypto pair that you're looking at, if it's been going up in a nice steady movement, this one is very possible that it could show up. What it does is it's going to consist of the bullish green candle followed by a bearish red candle. And the reason why it's called bearish engulfing is because that red candle engulfs the other one. It's bigger, it's bolder, and this can signify that a bearish trend is about to start. Now, this could take place on the smaller time frames or the larger time frames. It could be just, a short bearish movement, and then it could go back to the normal bullish trend. No one's ever for certain, but this gives you a key look into what the buyers and sellers are thinking, because everyone sees these exact same candles, so they start thinking along the same lines. And that's where we become a collective and we move stock markets with this collective mind. Now let's see. The next one is the bearish tweezers. That one is going to signify a bearish trend as well. It comes along after there's been a nice uptrend. Same with the bearish engulfing. The reason why it's called tweezers is, well, it's kind of obvious. It looks like a pair of tweezers. And when you see that, you can automatically think, oh, hey, this is something that I should watch for, and it's possible that this trend is going to change and become bearish. The next one we have is the bullish engulfing. Now, the bullish engulfing is basically the opposite of the bearish engulfing. It's going to appear during a bearish trend. It consists of, obviously, the bearish candle, followed by a bullish engulfing candle. It is likely that a bullish trend will happen after you see those bullish engulfing candles. Those are the trends we really like. Now we have the bullish tweezers. With the bullish tweezers, it's the exact opposite of the bearish tweezers. I like those. I like seeing them because I know that an upside is definitely possible. All right, the dojis we'll go over here in a minute because there are a few of them that I'd like to touch base on. Then we have, let's see here, the evening star over here in the left middle. That one is going to be the opposite of a morning star, and I'll touch on the morning star here momentarily. The evening star is going to appear during a bullish trend. Basically, what it's going to tell you is it's going to start with the bullish green candle. It's going to be followed by a small bearish or bullish candle. It could be different each time. And then it's going to, what that candle does, that middle candle right here, it signifies that it's black. That candle could actually gap up slightly over that bullish and bearish candle. Not always, but it's very possible that it could. So there might be a little space between those candles on a chart, and that's how you'll know that it's possible it's an evening star. Then it's going to be followed by a bearish candle that is lower than that middle one. And the third candle should technically cover at least half of the body of the first candle. So that red one, that red candle should cover at least half of the first green candle to form a decent evening star. This is going to signify a downtrend. With that, we'll go to the morning star over here towards the right in the middle. This one is going to appear during a bearish trend. It's the exact opposite of the evening star. It's going to start with the bearish candle, be followed by the small candle in the middle that's either bearish or bullish. It's going to gap down, so usually it's going to be lower than the bearish and bullish candles. And then the third candle should actually be higher than that middle candle. This picture doesn't really represent it well. Personally, I like seeing the evening and morning stars on my charts. Those are something I look for pretty much anytime I'm trading, whether it's the stock market or Forex. Let's see here. Let's do the hammers. All right. No, I'll save the hammers for y'all because I have a better picture that shows a few of them. Okay, we'll do the shooting star over here in the right middle. The shooting star, it's going to look like a hammer. It's going to have the same structure as an inverted hammer, which is, that's why we're going to cover the inverted hammer here momentarily. And the shooting star, it appears during a bullish trend. What this signifies is that the price that's been increasing, it's showing you that it can stop and that we're actually going to expect a downtrend. So that's definitely, the hammers are very important to look for. They show that whether it's green or red, it's going to show that either the buying or the selling power has dropped. And so a change is about to occur. Let's go with the 3 white soldiers. So with the 3 white soldiers over here in the right bottom corner, that's going to show up after a downtrend has happened. So if the price has been going down and the selling pressure has just consistently kept up, what these 3 white soldiers, even though they're not white, what they show is that a new trend has possibly started, an uptrend. So this is something we definitely want to look for. This is basically going to decide whether you're going to get in a move or stay out. I personally, when I see the 3 white soldiers, I usually go in on the second candle if I feel confident in the move. Now, let's see here. The 3 black crows is basically going to be the opposite of the 3 white soldiers. They're going to show up after an uptrend has happened, and they signify the start of a downtrend. Now, let's see here. The 3 inside down and the 3 inside up, I won't cover those just because I personally don't look for them. If you want to look them up afterwards, that's definitely up to you. Not every pattern or candlestick type is going to be as widely known. And to me, those 2 aren't as significant. But that's my personal opinion. And that's just how I feel about it. Let's see here. The left bottom corner, we have the spinning tops. Now, what these do is it's a candlestick pattern that has a short body, obviously, just a little bitty body. And it has long upper and lower wicks, or shadows. Sometimes they're called that. Not always. Usually it's just called an upper and lower wick. What this is showing or presenting is that there is indecision about the future direction. So it's basically kind of like you're going to the grocery store and you don't know what to buy. That's where the spinning tops are. They are the market version of, oh, I don't know what to get today. They are indecisive, and it means that neither the buyers nor the sellers could get the upper hand. So this is something that you should definitely pay attention to, because when indecision happens in the market, bad things could happen or good things. It depends on the day. But it also affects how the stock or pair or anything moves. It's going to cause a ripple effect. With that, let's see. So I didn't go over hammers yet. Let's see here, and dojis. Let's see. All right, let's go ahead and dive into the doji candles. Now, these are my absolute favorite. I love looking for dojis on the chart. Why? I don't know. It's probably Billy's fault. Don't tell him I said that. So there are a few different things you're going to want to look for. These 5 that are showing are, in my opinion, the main 5. Now, the dojis, what they're going to do is they are going to represent indecision as well. And but it's a different kind of indecision in reality. These are obviously represented by more of a cross shape in regards to the Doji Star, the long-legged doji, and the 4-price doji. There is no body at all. It is just the open price, the closing price, and the high and lower wicks. There's no body to be seen. Now, with that, what that means is we'll go with the Doji Star first. The characteristics of this are going to be a cross shape, very clearly seen here. It has the same open and closing price. It is small and equal in length with the upper and lower wicks. It's going to indicate indecision. I always look for dojis if I'm in an active trade, because once I see that doji, I'm usually thinking that it's time to get out. If I'm on a smaller time frame, then I can know in the back of my mind that there is a possibility of a direction change. Now we have the long-legged doji. What this one does is it's an extended upper wick with the extended lower wick. So kind of like a stretched out Doji Star. This one is signifying greater validity in the market. So we have the Doji Star next to it. That one just shows that the buyers and the sellers couldn't decide who wanted to be in control. Well, when the long-legged doji comes into motion, that means that there was a lot of price action in that candle, but neither the buyers nor the sellers could decide who wanted control. So it was kind of like a swinging motion. It was swinging back and forth until that very close, and no one won. This also signifies indecision. Then we have I'm going to skip over to the right, the dragonfly doji. This one is going to appear at the bottom of a downtrend. So we like this because it is bullish. That's definitely a good one to look for. It's going to show the rejection of lower prices. So you have the sellers that are trying to push the price down, and this dragonfly doji with the buyers comes along and says, nope, we are stopping the price here. We are going to go up. which is good. We like this. It's going to change the direction of the trend. Then we have the gravestone doji right next to it. This is going to be the opposite of the dragonfly. It's going to appear at the top of an uptrend, and it's going to show the rejection of higher prices. This is definitely a bearish signal, and it's going to show a change in direction as well. And last but not least, we have our 4 price doji. This one right here is sometimes called ultimate indecision. It is a horizontal line with a extremely small upper and lower body wick. This here is a very unique pattern. It shows indecision and low validity. So it's basically the opposite of the long-legged doji. Now with this, you have the doji family. Something you should definitely learn, get to know, and study. Go look through all the charts and just start picking through it. I personally spent at least an hour for the first week or so just learning dojis. And I would ask a few people in the Discord. I'd be like, hey, what is this one? What does this doji mean? Why am I seeing this trend after this doji? And how does it all fit together? Once you're able to see those movements, you can start to trade better. You learn to think on the fly. Now we're going to get into the hammer family. With this, we have a couple to learn. They're pretty easy, not too difficult, and definitely another candlestick type that you should know and have in the back of your mind. I do actually have a few charts that I have printed out with different candlestick types, just because when I'm trading, if I'm not on my phone, if I'm actually at my computer, I like to be able to see them in the background so that I can keep them in the back of my mind and know that, hey, I should actually look for this movement so that I can understand what other traders who are in that same stock or pair are thinking. Because, as I stated earlier, we are a collective mind. Not everyone realizes that, but once everyone does, then you learn how to go with the flow instead of against it. All right, so the first one here is the hammer, just the plain hammer candlestick. This is a price pattern that's going to occur when a trade goes significantly lower than its opening, but rallies within the same period to close near the opening price. What that means is you see the lower candlestick, the lower wick is extremely long. So the sellers were in control for a large amount of that candle time frame, but the buyers were able to rally together and bring that price back up. This is going to form the obvious hammer shape that you see here, and it's going to represent the change from a downtrend to a upper trend. We do like to see these on the charts. It's kind of like a doji, but it actually has that body to signify that there are buyers in control or sellers in control, and that there's a change that is about to occur. The main difference is obviously the body. And let's see here. Now the inverted hammer, it's basically the opposite of the regular hammer. This is going to, it also signifies a downtrend to uptrend change, but it's showing as a longer top upper wick. And what this does is show this is why I mentioned the shooting star earlier. It's called a shooting star when it appears in an uptrend. So that's definitely a key takeaway, because the shooting star, if it's showing in an uptrend, signifies the beginning of a downtrend. Sorry if I stumbled over my words right there. Now, kind of like the shooting star, but a little bit different, is the hanging man. So it's the hammer, but at the very top of an uptrend. So this is going to signify the start of a downtrend. That's always something to think about. If you see a hammer on an uptrend, you're going to automatically realize, oh, that is a hanging man. But if you see a hammer at the bottom of a downtrend, you're going to say, oh, that is a hammer. And that signals an uptrend. So that's definitely something to keep in mind, is that a lot of these candlestick patterns can have different meanings depending on where they are in an uptrend or a downtrend in the chart. And that's always something you have to pay attention to, because one obviously tells you something different than what the other one is telling you. I made that mistake plenty of times. Now let's see here. All right, so we're basically done going over the types of candlestick patterns, the charts that I'm about to show you. These are going to signify a few different charts that you should have knowledge of. Now, this one right here, I had words on these, but they're a little dark. This right here is called some of you might realize this, others might not, and that is okay. But this is a head and shoulder movement. This is a head and shoulder chart pattern. What this one is showing is you have the large peak in the middle with a smaller, and it doesn't have to be too much smaller, just slightly smaller. The slightly smaller peaks on each side of it. This right here is going to predict a bullish to bearish reversal. So these show when it's been a nice upward trend movement. It's been bullish, everything's been great until you see this. The head and shoulders is extremely well known. This is one of those chart patterns that almost every trader, I would hope every trader, knows about. And when they see this, you automatically should realize that this is showing a bearish trend once the second shoulder has finished. Now you can barely see it, but I do have a line drawn where the tips of these long red candles are actually touching a dotted line, and we're going to call that the neckline. That is basically showing you that the breakdown on the right happens once it breaks through that neckline area. And in the next video, I can actually do some charting and show y'all a few of these chart patterns on a few recent stocks or pairs. I think I've seen a few recently, so that shouldn't be too difficult to find. The next one we have here, and you can kind of see the circles in the background, but not really. I have two circles circling the very top wicks of those candles that look like they're about in the same area. This is called a double top chart pattern. This is going to highlight a trend reversal. With this, the double top is kind of like the head and shoulders in a sense that it's signifying a bearish trend from the bullish. Now, the next one is going to be the opposite of the double top. We have the double bottom. Wow, what a convenient name, right? This one is going to indicate a period of selling. So the price has dropped significantly, possibly even below a support level. Then what it's going to do is it's going to rise up, as you see on the right, and it's going to hit a level of resistance. I'll be going over support and resistance in the next video. And then what it's going to do is it's going to drop again. So that's the middle area right there. It rose up, it hit the resistance, and then it dropped down. Then what it's going to do is it's going to reverse to begin that upward motion as the bullish momentum picks up. A lot of traders will call this the W movement. You always want to see this in a bullish trend because you see this and you're like, oh yes, okay, the buyers are in control. This is a bullish reversal pattern because it signifies the end of a downtrend and the shift towards the uptrend. Now, these can be short-lived or longer-lived. It depends on what time frame you are on. I see a lot of W patterns on the 15-minute time frame or the 5-minute time frame. Once you go farther out, you can get, I'd say the 4-hour time frame. You can actually get a grand picture overall and see that the overall movement of the pair or the stock is bullish or bearish. So if it's the double bottom, you're going to know that, hey, we are in a bullish trend. Things are looking up. Things are great. Or if you have the double top, you'll know, hey, we are in a bearish trend and I should definitely be careful when I decide to buy in. Let's see here. All right, this one right here, I do have a line drawn. Once again, it's kind of hard to see, of course. This is a chart of a rounding bottom. You can kind of see that from the picture here. It looks like a kind of, not really a cup, but a bottom that's slightly rounded. Then you have the long uptrend momentum. This is signifying a continuation or a reversal. So with this one right here, this is a bullish reversal rounding bottom. This would be the case of an asset or pair that the price was in a downtrend, as you see on the left here. Then a rounding bottom has formed, and what that area is showing, it's showing kind of like consolidation. The price really isn't moving up, but it's not really moving down. It's kind of just staying in one area while slightly moving upward. So then we have the finishing of the bottom before the trend has officially reversed and entered that bullish uptrend. Love seeing these. I've seen a lot of them in the stock market recently, pretty much everywhere right now. Everything's been reversing from the downtrend to the upper trend, which is what we want to see. The next one we have is the cup and handle. It is similar to the rounded bottom in a sense that it has that rounded area. It is slightly different because instead of going straight up on the right here, it actually fell just a little before continuing in an uptrend motion. So it's a bullish continuation pattern, and it's showing the period of bearish market over here on the left before it consolidated and moved into a bullish trend motion. So the handle is, and I'll go over the wedges here momentarily, it's similar to the wedge pattern, just a smaller form of it, and then the trend finally broke above to finish out the cup and handle. With this, we will move into the wedge. And I did have lines for these guys. What the wedge shows, they form as the price movement tightens between two sloping trend lines. So if I were to draw some lines on these two charts here, it would be trending, well, wedging up in an upward motion, but they wouldn't be perfectly parallel. They would be slightly slanted, forming that wedge motion. There are two types, the rising and falling wedge. Now this one right here in front of you is the rising wedge. This is going to be represented by a trend line caught between two upwardly slanting lines of support and resistance. And I will go over that on the next video where I can actually see the lines. In this case, what's going to happen is with the rising wedge, the resistance, which is going to be the top line in this picture, which we can barely see, and the support, which is the lower line. Now what happens is, as the second part of the picture shows, the support line, the price movement broke down through that support. That is why this shows a bearish movement. So it starts off bullish and then it shows that bearish drop. Now the falling wedge, which, let me bring that up. This is a falling wedge, so it's going to be the opposite of the rising wedge. It's going to be a downward momentum movement, and this could take place over minutes, hours, days. We'll go over the trends. This right here, it's going down. You see clearly that it's going downward. But you have the resistance on the top and the support on the bottom, just like with the rising wedge. And with this one, the resistance, the price action actually broke above the resistance line. So this signifies the bearish trend reversing into a bullish trend. All right, so that is the wrap up of the main chart types, candle types. Let me know if I didn't cover something that could be covered in the next video. I can definitely mix and match with support and resistance. That's not too hard to do at all. Something I do want to mention, an uptrend is going to consist of higher lows and higher highs. So that is something to be watchful of. The downtrend is going to consist of lower highs and lower lows. Now, when you are trading, and I see this all the time, and I'm guilty of it myself, because sometimes when we're trading, we don't want to pay attention to the overall trend movement. If a trend is overall bearish, you do not want to buy in that bearish trend. If you do, you had better make sure that the movement you make is short, sweet, and to the point. You get in, you get out, you don't plan on staying in forever. You make that money and you run. Don't hold. Same with a bullish trend. If you are going to sell in a bullish trend, those movements, they need to be short and sweet, because otherwise you are going to get stuck and you could lose money. And we definitely don't want to lose money in any market. That's not the goal of trading at all. So if you're trading with the trend, then obviously overall you are going to be in that movement longer. If you're trading against the trend, that's when a lot of people do scalping movements. Those scalping areas are great for making quick, fast money, but don't stay in them, whatever you do. And I think that actually wraps up this video. Like I said, please let me know if I didn't cover anything that you might want to know about. I can definitely cover it later on. I plan on doing more videos soon. So y'all have a great one.